Testing.
Testing. Testing. Good. So, ladies and gentlemen, hope you had a refreshing break with some good juice, tea, coffee, or some snacks. We shall now continue with our session. Before that, you will remember, for those who were here yesterday, we had another member of the MC team, Yashvi. So allow me to leave you in her good hands for leading us through this session now.
Thank you, Ludasen. Good morning, ladies and gentlemen. Welcome to this panel discussion on a pressing and highly elusive issue. We are talking about tax non-compliance from digital operators. You know, Ludasen, it's kind of like that friend who forgets to pay you after dinner. Only this time, we are talking about billions of dollars. Ladies and gentlemen, the rapid digitalization of economies has transformed the tax landscape. While it presents tremendous opportunities for growth and innovation, it also introduces significant challenges to tax administration, especially in ensuring that VAT is effectively collected. Ladies and gentlemen, let us uncover the mysteries as to how digital businesses are able to get away with their fiscal obligations and figure out how we can turn this plot twist into a happy ending for us tax administrations. To help us with this, ladies and gentlemen, we have a panel of experts who would share insights on innovative strategies and successful initiatives that can be implemented to tackle this problem. Ladies and gentlemen, this exciting session is going to be moderated by none other than Dr. Awa Diouf from the International Center for Tax and Development. Our moderator's work focuses on boosting tax revenue while ensuring equity and financial inclusion, digital financial services, digitalization of tax systems, and taxation of the digital economy. Ladies and gentlemen, please join me in welcoming our moderator, Dr. Awa Diouf, on this stage. Please have a seat, Dr. Awa Diouf, while Ludasen brings on board our panelists for this session.
Yes, Yashvi. So our panelists for this interesting session is, first of all, Mr. David Boja, Mr. Kehinde Victor Kayesomo, and Mr. Emeka Nwanko. So we leave the discussion in the safe hands of our moderator here. Please.
Good morning, everyone. Before we begin, I would like to express my gratitude to Esther and her team, but also the Mauritius Revenue Authority, for giving me the opportunity to moderate this third session on countering tax non-compliance from digital operators. Awa Diouf, I'm from Senegal, and I work with the International Center for Tax and Development, which is a UK-based research center focused on exploring tax and development issues, mostly in African countries. I will begin by introducing the panel with a quote from OECD, simply saying that the digital economy is increasingly becoming the economy itself. So this simple but also powerful statement captures the remarkable shift from traditional transactions to digital ones. So shopping for goods and services has never been easier, which is good for us ladies, but it also comes with issues for tax administrations because this shift also means a change in the nature of the tax base and requires an update or adaptation of tax collection strategies. So value-added tax is a crucial source of revenue for government all over the world. However, the rapid expansion of online sales and services creates significant challenges in ensuring compliance from digital operators. However, these operators, just like any other enterprises, they have to collect and remit VAT. This will not only ensure that tax collection revenue is effective, but also make sure that there is a playing field between companies. Yet, digital economy is inherently borderless, and the complexity of cross-border transactions, and this is true for services, makes it increasingly difficult to for tax administration to trace and collect VAT effectively. So today we're here to discuss these challenges and explore how different countries are tackling VAT no compliance by digital operators. So our three panelists, each with extensive experience in this area, will share insight from different contexts, different countries, and different perspectives to better understand the way forward. So to begin, each panelist will have 5 to 7 minutes to present their perspective. Following the presentation, we will engage in a discussion by asking questions about the key challenges and solutions. And we hope that this session will provide practical takeaways to help us all understand and navigate the complexity of the implementation of VAT on the digital economy. Let us begin with Emeka Nwankwo, the head of member services at the African Tax Administration Forum. Emeka brings over 14 years of experience in tax advisory and policy development, and co-developed the VAT Digital Toolkit for Africa, which serves as the go-to document for best practices on implementing VAT in the digital economy across Africa. Today, he will share insight on the roles and obligations of digital platform operators in collecting VAT on online sales. But before giving the floor to Emeka, I would like to share a fun fact about him. So I've asked him, and he said that he likes to learn about random things. As a researcher, I wanted to know more about what a random thing is, and he wanted to know why my name is Awa. So I think that we have a clear idea of what his hobbies are. Emeka, would like to...
Good afternoon. Thank you, Awa. Thank you to CATA. It's a pleasure to be here to share a bit of our experience. I think most of the conversation this morning, while it might have been around, especially from Akim's presentation around the global minimum tax, the GMT, Akim kind of skipped the VAT part, but I guess he was reserving that for this session. So that is great. But just to say there's a lot of interaction also, whether we see it implicitly with the discussions that's going on around the conversations on international taxation. I know we always look at VAT as a domestic tax issue, but within the globalized world, that interaction is happening. So we're having more globalized conversations around VAT. And as Hawa has said, I have 5 to 7 minutes because I had pre-warned her that sometimes I enjoy talking about this VAT so much that I might go over time. But I'll try to keep within time and not speak so fast. But just to lay the foundation for the conversation, I'll be sharing a bit from my experience working with the OECD on the Digital Toolkit for Africa, which is basically taking the international VAT guidelines and the mechanisms for collection and trying to shape that into what we've seen on the continent and how that fits. I think there was a slide about knowing your landscape. So he's taking that and looking at the landscape on the continent and saying, how does that work for us? How do we look at it? What view do we take? And what should countries consider in that perspective? But for us to talk about VAT on cross-border supplies, we need to understand what we're talking about in that context. Here we're talking about, again, transactions cross-border, but why is it something we need to pay specific attention around? I'll leave a bit around the VAT efficiency. Again, there was a presentation I shared about VAT efficiency on the continent. You find that most of the, while VAT contributes majority of total tax revenue, the efficiency is still low. So there are still gaps in that context. And one of the areas to fill that gap is also looking at digital economy, but more or less cross-border. So this is why this is important. And the critical part of this is because of the scale to mass concept. The fact that I can be here in Mauritius and be providing services to all the 50-something countries on the continent and beyond. So I could be in Mauritius without having to have any presence anywhere in the world, make supplies to 100 countries, 120 countries, customers in those places. So that becomes the first issue. Because again, prior to now, for you to do business, or we're used to goods, even for services, you have to probably be there in person, in country, to provide that service. So this skill to mass becomes a concept we have to deal with within VAT. Second is the mobility of consumption. And when I say mobility of consumption, we all have our phones. We have Google Play, we have Netflix, we have the Apple Store. We're here in Mauritius. You could download a book, you could watch a movie, you could have entered into that contract with the streaming provider while you were in your country of residence. But you're here in Mauritius, probably you're watching all the movies you can. You're reading the books, or you're playing the games on your phone. The question becomes, now where is the consumption happening in that context? So this is where mobility of consumption happens. And in some cases, you're traveling across 5, 6 countries and you're consuming that content. What happens in that context? Do you split it? Do you try to identify how much you've consumed within each jurisdiction? That might be impossible. So that again calls for attention for us to look at it and see how is that done. And then the final part is the fact that payment system is no longer we just paying cash or over point of sale. There are various forms of payments on our phones. Is there visibility over that? How do we improve visibility? How do we track that to understand the transactions and all? So these are the 3 major things we have to look at when we're thinking of VAT cross-border. How do we resolve those issues? And in order to deal with that, I usually start with saying it's not a new tax, because sometimes when you engage with any authorities, there's a fear of, are we introducing a new tax? No. It's basically expanding compliance to existing, if you look at VAT, it's on goods and services, except where the law clearly exempts such supply. In this instance, in certain cases, because of administrative inefficiencies or limitations, we are not able to administer VAT on such transactions. So again, part of how we look at this is, these are transactions that probably, or supplies that probably normally under within the VAT scope. But now we're providing and extending compliance on how that should be administered and how compliance should work. And to do that, we have, basically, I mentioned International VAT Guideline, which was published in 2015, trying to look at what are the considerations, what do we need to do to be able to capture this and, administer and improve compliance around these cross-border transactions. It was further supported by the mechanisms for collection, talking about how do we collect in that context. With those, ATAF also published policy considerations taking the African context in how we define goods and services and such, sometime in 2020. And in 2022, after about 1 to 2 years of work in collaboration with the OECD, emanating from the previous work done, we were able to publish the VAT Digital Toolkit for Africa, which now comprises of all this between the policy considerations and the administrative mechanisms for collection. So all this basically informs what we call the simplified regime, which is looking at how best do we collect this VAT. And why I point out the simplified regime, because I'm talking about the role of digital platform operators. This is where it comes in. Because for us to capture this, the supplier usually, again, within the context of VAT domestically, accounts for the VAT. But now you have non-residents who make these supplies. So how do we bring them within that space? That is where the simplified regime comes in. But the simplified regime is built around about 4 pillars, which is looking at the scope of VAT and the regime of that simplified regime. What is captured? Who is a non-resident? What type of supplier we're looking at when we talk about digital services? The second part is determining the place of supply or place of taxation. I spoke about mobility of consumption. So how do we determine where this should be taxed? Where does the taxing right sit? Is it with the country where you entered the contract? Is it where you're consuming it at that time? If you look at the concept of utility, for example, or concept of consumption. So how do we determine that? Then how do we collect it? And finally, what are the administrative processes to enable this collection? With that, so in terms of scope, we're talking about the what is covered. Place of supply or place of taxation is when does the incident of taxation happen and where should that be? And then collection mechanism is who should collect, who has the responsibility or obligation. And administrative process is basically how is this collected, what are the things in place. Just to set this thing for place of supply, is based on place of taxation, which is derived from destination principle, meaning the VAT incidents or the VAT rights or collection should happen where the consumer is, if I'm to use it that way, the location of the consumer. But I spoke about mobility of consumption, so that becomes an issue. How do we determine location of the consumer? we look at the place of residence. But then again, we remember these are highly digitalized environments, meaning these transactions happen in microseconds. How do you determine residence in that space? So there has to be predetermined indicators or factors to look at. And again, these are system considerations, so they have to be built and programmed into the system. So it has to be simple and easy enough for the system. So that's where the indicators come in to simplify that. Now, typically, these indicators sit around the bank where you're making the payment from, where is it authorized, is in your jurisdiction, the address, any other form of identity showing your jurisdiction. Of course, there's the issue of geolocation, IP address and such, but we're aware of VPNs, which means you could change your location. So again, it's to look at stable indicators. Now, coming further down now to who has the obligation and looking at the role of digital platforms, we have to look at the concept of B2C, business to consumer and business to business. I spoke about that normal concept and principles of VAT. The supplier has a responsibility usually to collect the VAT. Within this cross-border space, we have to look at B2C. The B here is the supplier. The C doesn't necessarily mean an individual in terms of legal person of an individual. It simply means a non-registered person for VAT purposes, because that automatically makes you a C. Because usually within VAT, once you're a registered VATable person or someone that registered for VAT purposes, you automatically have the responsibility to collect the VAT for the transactions, for the supplies you make. So when we talk of C here, it's someone that is not registered for VAT purposes. Now, the international guideline suggests a B2C regime for the cross-border transactions. The idea here is that in B2B, you have either the reverse charge, and of course there's a new fact that in most jurisdictions, the VAT paid on imports is nilled off. So basically it's a zero, it has no effect on your collection basically in that context. So it suggests a B2C approach because the idea is to capture those transactions done by those not registered for VAT purposes. And this is because if you told a maker, every maker in the country, to account for VAT when they make these transactions, then you have to do basically almost the whole population. That becomes cumbersome, becomes hard to enforce. So here is how do we then capture that B2C. But why we add the B2B here and say all-inclusive is on the continent. We've seen countries go for an all-inclusive approach where they combine both the B2C and B2B in the simplified regime. There could be two reasons for this, which I will share as we go. Here I've just put what you should consider, but because of time I wouldn't go into it because there's a bit of stability consideration of what works within your existing VAT system for you to do that. But part of the reasons probably on the continent this has happened is one of the first countries to implement any regime at all in the world around VAT on cross-border was South Africa. And then we have the peer-to-peer learning. So most countries saw that and probably picked up on it. But the second fact is also the maturity of the tax administration system, because this has to do with how much either your compliance risk or assessment process, how much information do you have? Now, for most countries, the concept here is, first of all, the VAT system doesn't differentiate between B2C and B2B within the legal framework. So it will be harder to do that within the simplified regime. The second part is that when you do B2C regime only, you need the systems to be able to identify who is the C and who is the B to now accord it the VAT treatment that it requires. In most countries, you have unique tax identification number, but again, sometimes it's not smart or it doesn't have the smartness built into it to identify an individual or someone that is not registered for VAT or not. Because one thing is, we have the registration for tax purposes where you get your TIN or your tax identification number, but there's a second level of registration, which is where you register for tax types. So we could all have tax identification numbers, but we're not registered for the same tax types, meaning that I have a tax identification number doesn't mean I'm registered for VAT purposes. And this is because of the concept of thresholds within VAT, which requires to be at a certain threshold to register. So in that case, the system has to be able to identify who is registered for VAT. This becomes complex for some countries, so they do all-inclusive. But just a slight highlight on what is happening on the continent. South Africa has an all-inclusive approach currently, although it's moving to a B2C regime. Nigeria, Ghana, Kenya all have all-inclusive. Uganda currently has a B2C regime. South Africa is planning, I think, in the last Finance Act to move into a B2C regime. But here is about what suits the context of your country and what happens. Now, talking about the B2C, B2B dynamics, this is where we come to the obligation to collect and the role of digital platforms. Why is it important? Where you have, again, a B2C only regime, what happens in that space is, if within the domestic law, a reverse charge or withholding VAT concept is applicable, in a B2B transaction, the obligation to withhold or reverse charge that VAT falls on the consumer who is consuming that transaction, meaning the VAT registered person receiving the supply within the jurisdiction. Where it's someone that is not registered that is receiving the supply in that context, in that case, the non-resident supplier would have the obligation to account for that VAT. Where you have an all-inclusive regime, what does that imply? It means that for all transactions, notwithstanding if it's a VAT registered person receiving the supply or a non-VAT registered person, the vendor, who is the non-resident supplier, would have the responsibility to collect the VAT in that context. If we take that a little bit further, to break it down, just like typical stores, in the first part, we're talking about where you have a business who is making supply of his own products directly. So let's say an online store, he makes one supply. But there's a second level where we have what we call, because sometimes when we say the digital marketplace operators, we can mix it up. We have the intermediation services, which is the real marketplace. This is like the Apple Store on your phone, Google Play, those are marketplaces. Meaning, it just creates liquidity of suppliers and consumers to interact with each other and conclude transactions. This is common in short rental accommodation space. We have such apps. Ride-hailing apps, those are marketplaces and such. So what happens in that context? Who has the obligation? Here, looking globally and again within the continents, the approach to it is either to have a full liability regime, where a marketplace operator is responsible for the VAT for all transactions on its platform. But within marketplaces, there are two levels of transactions that need to be accounted for. There's the service of marketplace provision provided to the suppliers by that marketplace operator, by the intermediation service provider. That's one level. So if there's a supplier from your jurisdiction, for example, who is paying the marketplace person to be able to use their marketplace, that is a separate transaction or supply that has its own implications. The other level is the supply between, so you have what you call the underlying suppliers. Those suppliers that are on the marketplace when they supply to the consumers. That's another transaction. Good example of this is if I'm a driver of a ride-hailing app. Whenever I do a transaction, the ride-hailing app charges me a service fee. That is one transaction. But there's the payments from the rider to the driver. That's another transaction. So in the case of full liability regime, what we're talking about here is for the payments or for the supply from the driver to the rider, the platform would account for that VAT, beyond just accounting for the one of the service fee for the driver. But to do this, you also have to look at how the marketplaces, the business model works. They have to have a view of the financial transaction and control for them to recover that VAT. Because in some instances, all they do is connect consumer and supplier, and they don't get involved in the financial transaction or have control over it. So in designing this, you have to look at, again, do you have to layer the rules to say where you have financial control or where you're able to recover your service fee, you should be able to recover the VAT also. I think Kehinde will share more on that, because I think Nigeria kind of inserted that concept to say, beyond having financial control, if you're able to recover your service fee or any form of fee from the supplier, then you should be able to recover the VAT. The other part is just to say they should provide information if they don't have control. They should be able to report transactions or the people that players on their platform in that context. What are the common issues? Is the high volume of transaction. There's a big issue around invoicing. A lot of countries are implementing e-invoicing at the moment or digital transaction reporting. But we're seeing where it's a bit of a challenge having to integrate that with the non-residents to their systems. Because how you have to think of it is, I'm a non-resident making supply to 120 countries. But then I have 120 e-invoicing rules that I have to implement on my system. How does that work? So this becomes an issue. But these are some of the things we have to look at, how can we have conversations around them and such. Limited access to information, how much reporting is too much and how much is too little. Because we call it simplified regime, usually the return is a summary return. It doesn't give you the transaction level return. But how much information is too little and how much is too much to ask from the businesses. But generally for countries, three things is to look at lead time. Sometimes we do this because we're looking at the revenue yield. We want to implement within 3 months. Or, I mean, the law might be there, but the supporting instruments and even the framework for compliance is not there, but we're seeking compliance. So that is lead time for businesses to prepare, but for you to also prepare as a revenue administration. And then, of course, the readiness, be ready. But communication is important. From the beginning, as you start designing, you have to consult, you have to engage. Because those that are to comply need to understand what you're designing for them to also prepare for compliance in that context. So communication is very critical from beginning to the end, and it even matters for your own risk assessment process in terms of your stakeholders. The central bank, everybody you can get information from, also needs to be involved to know the role they play at the end of the day. What's the journey so far? About 20 countries have some sort of provision in their laws on the continent around the cross-border transaction. But having the provision is different from implementing in that context. Most are in the process of trying to implement and provide those frameworks. For us as ETAF, we've worked with about 12 countries to see how to implement this process. And I think within those, about 6 or 7 have gone ahead to implement in the last 2 years. And from those countries, I think from about 5 countries within the space of 2 years, of course, different levels. This is a system that is a voluntary-based compliance system, so it takes time to mature as you learn and improve the system. But from about 5 countries so far in the last 2 years, we've seen about collection of over $240 million specific to the regime across those countries at those different maturity levels. So there's an opportunity there, but it's one of those that keeps improving as the compliance maturity also improves. I think with time, I'll just stop there. Thank you.
Thank you, Emeka. So I would like now to invite David Borja, the Executive Operators Officer at the Inter-American Center for Tax Administration. He has over 16 years of experience and has led digital transformation efforts in the tax sector, making him well positioned to discuss the control and taxation of online sales, particularly through digital platforms. So today, he will share insight on tracking digital transactions, focusing on the digital economy compliance tool, which is used by many countries across Africa and Latin America. But before giving him the floor, I would like to share a fun fact about him. So when he does not advise Latin American countries in how to trace Netflix transactions, he likes to play soccer. So please join me in inviting
Okay. Verifying everything's working. So first of all, I want to thank Mr. Sudamo Lal, General Director of the Mauritius Revenue Authority, for your hospitality and for organizing this magnificent event, and congratulations for all the people who are involved in this activity. And thank you very much, Dr. Esther Cousin, CATA Executive Director, for inviting CIAT to have this conversation with all of you. As you said, I was a soccer player, and I like to be the number 13 in the STAR team for the soccer games. So it's the same I used it when I was a soccer player. So what we want to cover in this short presentation is an overview of the VAT in Latin American countries, using a survey, an international survey that we have in CIAT, and now it is through a partnership with the IMF, OECD, IOTA. And later I will speak with you about toolkit, the same that Emeka showed us, but in Latin America, to make you understand why it is important, why it's important to dedicate time and resources for controlling the VAT in the digital economy. And also I will show you a tool that we developed with international cooperation. So CIAT is the oldest organization, the regional tax organization, the oldest one. We have 42 member countries. We share some member countries with CATA. And what we do, we mainly are focused on tax studies. We perform some publications. We provide some training and also technical assistance, which is one of our flagship products that we have for our members. As I said before, I would like to show you some highlights of this study, based in the International Survey of Revenue Administrations, the ISORA. What is important to mention is ISORA is a very good tool to understand the actual development of the revenue tax and the tax authorities. No? So what is necessary to understand is the total VAT in our Latin American countries has a very, very important place in the total revenue. No? For example, for CAT members, it is 30% of all the revenue that we collect. No? And in some countries, for example, particularly in Ecuador, the place where I was born, is 49%, no? The VAT is very important. El Salvador is 49, and Chile 51%, which is very interesting. No? The VAT, which is related with providing services and goods, no? Online, is something that we have to pay attention in our country's members. No? Another important thing to understand is that, as we received some information yesterday, filing tax returns right now it is online. No? Online filing tax return is something that we have developed a lot in Latin American countries, based in the information from the electronic invoice and the technological development that we have in this region. So it is important to understand that the VAT, 68% of tax returns are filled online and on time, and 91% is filled online. So most of the tax returns related with VAT is received online in the Latin American countries. Just to give you an example, again, in Ecuador, El Salvador, 100% of the tax returns are sent to the tax administration online. The same happens with India, with Italy, Jamaica. It's 100% using these new technologies. No? As Emeka said, it is important to read these specific toolkits that are developed by the OECD. No? It's very interesting to understand how we can deploy some policies, mainly public policies and reforms in the legal framework of our organizations to control the digital economy. It is important to mention that in our region, to give you an example, in Ecuador, we use the transactions and the information of the transactions from financial entities, no? Mainly related with credit cards and non-bank financial intermediaries in the payment system. So using this kind of information is very useful for us to retain the VAT, and also to find how much it is how much we can collect, no, from their side. And it took, for example, in Ecuador, about 8 years to implement it, because we had to make an amendment for our constitution to use the information and be able to request information from the financial institutions. And when it happened, once we receive it, it is possible to understand and collect the tax based in this specific area. No? Based in these guidelines that we have from the OECD, what is important to understand is that mainly in some of our country members, it's important to reform the traditional VAT collection process. From my understanding and from my experience, I think it's very useful to start redesigning the processes and also the legal framework that we need to do it. It is important to highly reform the taxpayer registry, and also to determine the obligations, no? Who is creating a new activity, and the obligation to declare and pay for it. No? So it is necessary to do it. It is one of the main ideas that we have from this guidance. Another thing that I want to share with you is about the digital economy compliance tool. Is a software that we developed with the NORAD cooperation from the Norwegian cooperation. With NORAD, we developed a software that facilitates the process of collecting VAT and indirect taxes of the digital economy. This is a software, it's a public good, no, with a specific purpose. No, this is a public good. It means that you do not have to pay for it. It is free to use. We have as main functionalities a simplified registration, tax returns, filling, processing information, and some reports, which is very useful to understand how to collect this kind of taxes. No? Fortunately, we had the opportunity to share this tool with the OECD, and it passes all the actual obligations and definitions about the digital economy compliance. So the main characteristic of this system is that it is online or cloud-based. It is highly, you can parameterize it highly, no? And it is user-friendly. The system has security configurations, payment conciliation, report, the statistic, which is very useful to understand how to collect these new taxes. I hope it is possible. It's not possible to show the video, but what is important and what I want to say is that if any of the CATA member countries want to explore a little bit more about this specific software that we developed in SIAD through the cooperation of our country members and the NORAD, you can do it. No, it's only necessary to have a conversation with the STAR, and we can show you. Fortunately, and in this week, based in the interests of the Australian Tax Administration, we are working with PETA, a broader organization, to implement the system in the Pacific Islands tax revenues. No? So that's something important because they are evaluating their usage. And if you want to understand a little bit more about it, this is a tool, it is open source, so it's only necessary to have a conversation to share with all of you. So thank you very much for your attention, and we will continue with this panel.
Thank you, David. Let's now invite Kehinde to give specific country experience. Kehinde Kajesomo, I hope I pronounce well, is the Deputy Director and Head of Treaties and International Tax Policy Division at Nigeria's Federal Inland Revenue Service. With over 25 years of experience, he has played a pivotal role in shaping Nigeria's domestic tax policies. In fact, no law, regulation, ministerial order, or circular issued between 2013 and 2023 has been released without his input. Well done. So Kehinde will share his insight on implementing systems for recovering VAT from e-commerce transactions using Nigeria's experience as a case study. So Kehinde is a negotiator for tax treaties for Nigeria, and many of his colleagues in this room will think that he's a very tough negotiator. So if you want tips to do shopping later, I think he's the person to talk to. Kehinde, the floor is yours.
Thank you, Madam Moderator. For the organizers, I thank you for the invitation and for the opportunity to be here. So when it is bilateral, yes, you can be a tough negotiator. But I know when we get to OECD, and I can put you in the room, Akin will say, if you don't agree, you won't leave the room. So you have to be a tough negotiator, and you have to be reasonable when you are with other negotiators. Colleagues, I will be speaking on the experience of Nigeria in implementing the collection of VAT from digital activities. After the release of the BEPS outcome, what we did in 2017 was the Nigerian government set up a committee called the BEPS Implementation Committee. And the committee was to look at all the 15 action plans and make recommendations to the government on the implementation of any or each of the BEPS action. So one of the actions review was action 1, which is on taxation of the digitalized economy. And one of the inputs, what was taken out, one of the things that was in the report on action 1 was on how to use indirect taxes, to focus on indirect taxes to collect tax from a digitalized economy. So as a policy, one of the first policy options for Nigeria was to explore that possibility of leveraging on VAT as a means of collecting taxes under the digitalized economy. So other policy issue for Nigeria, after deciding that based on action 1, we want to look at indirect taxes, we also have to look at how big the issue is. Because it shouldn't be an issue of spending so much money to run after rules that at the end of the day you collect little or nothing. So we had to run some statistics to look at how big the issue is for Nigeria and the possibility of revenue collection when implemented. Another policy decision that needed to be taken was the fact that we needed to focus, because we also reviewed the OECD GST guideline. And one of the things we did was to also align with that guidelines by focusing our law and principle on collecting from destination. We adopted the destination principle, because if we collect on origin, another country collects on our destination, there will be likelihood of a double taxation. So we decided to align with that and focus on destination principle, meaning that every item that is consumed in Nigeria, even if the seller is not in Nigeria, is liable to VAT in Nigeria. Then we needed to also look at separation of the issues into B2B and B2C. And I think Emeka explained very well the distinction between the two, B2B and the B2C. Then after we have arrived at after looking at all the policy issue and we arrive at the decision that we want to implement, then we needed to go into approach in our legislation. And then one of the things that we did in our legislation, so the legislation was in our Finance Act 2019, and it was to amend our existing VAT law. And some of the amendments that we had to bring in to implement the digitalized economy was the issue of digitalization of the revenue authority. Because you can have a manual process and want to collect VAT from an entity that is run on digital platforms. So we had to digitalize our administration so that we are able to collect that VAT through digital process. I mean, so that we don't need to ask those non-residents to come and file returns in Nigeria. You must have presence in Nigeria before you can collect and make payment. The second thing we did in our law was to have the legislative provision for self-charge. Emeka explained the B2B and B2C. So the B2B, the intention was to allow the registered companies or the businesses in Nigeria to be able to withhold. However, I mean, we had a combined rules later, but the initial thought was B2C will only be by simplified registration and the B2B will be by withholding. However, we didn't implement it that way because I will discuss why we didn't go that route. However, even the route went through, there is possibility that the non-resident supplier will not deduct. So where the non-resident supplier fails to deduct, we have the self-account or self-charge rule to ensure that the consumer in Nigeria, which is a business, have to self-account for the VAT. We also had to reinforce our destination principle obligation in the law. Then we had to put a provision that requires non-residents to register, because there's no way you can fulfill VAT obligation if you have not registered for VAT. So we changed our law to require non-resident suppliers to register for VAT purpose in Nigeria. and also include VAT in their invoice. Of course, they can only have a VAT to collect for you if they have included the VAT in the invoice. So we amended the law to put that obligation on them. Then another thing we put in the law is to give the revenue authority the power to appoint agents or to appoint anybody to collect. And based on that power, the law isn't specific on who should be appointed. So meaning it can be a supplier, it can be gateway, it can be aggregator, it can be platform operator. The decision was left with the tax authority. Then we also have legislative clarification of the rule order for VAT, who has the primary obligation to collect, so that we don't have conflict of where one person is collecting, another person is collecting. Because if in one breath we say the operator should collect, and in another breath we're asking a business to self-account, there will be duplication of authority and function. So what we did was to create a hierarchy of rules so that we don't have such challenge. Then after putting the rules in the law, then the next thing we needed to do was to put process for administration. And under the administration process, the first thing we did was to set up, we set up an office that is dedicated exclusively for administering. Yes, they have other functions, but their core function was collecting VAT and, of course, income tax under our SEF rule from non-resident. So that office was focused on collecting taxes from non-residents. Then we had to go through some consultation. And for any country that wish to go into this, one of the things you can't run away from is consultation. Because it's not, Emeka explained that it's more of voluntary compliance. You leverage more on voluntary compliance. So you need to get the buy-in of so many stakeholders before you can start implementation. And ATAF is here. We consulted with ATAF when we drafted our guidelines. Even CEAT, also CEAT was a very good partner when we were starting the process. In fact, they offer us the deck tool. Unfortunately, we couldn't, at the last minute, we couldn't use it because there was another policy option to, instead of duplicating softwares, to focus, because that time we started a new software called the Tax Pro Max, which was developed in-house. So the policy decision there was, despite the fact that we appreciate CEAT for giving us deck 2, we decided to leverage on our homegrown technology to implement. So we consulted with ATAF, with CEAT, then with business at OECD. Of course, we also got the link from ATAF, who linked us with the business at OECD. And it was at this point, because I said our initial policy was to do only B2C. But it was at this consultation that our supplier informed us that it is better for us, because they told us about the policy challenge, implementation challenge they will have to separate B2B and B2C. And this is because the tax identification number in Nigeria is not distinguishable between business and customers. So their concern is that if you ask them to collect only from customers, there's no way they will know, or they are able to identify the individuals, customers. So, and they saw it as a very challenge for them, which may hinder their compliance. So we had to concede to them, and they did a combination of a B2B and B2C. Then we developed our guidelines, of course, with also consultation with ATAF. And so after developing the guidelines on simplified regime, the next thing was to deploy technology, which the law has empowered us to do. So because registration has to be simple, and that is why, of course, it's called simplified registration and compliance regime. The process has to be simple. You don't expect the business, the suppliers, to come to Nigeria or our jurisdiction to fulfill those VAT obligations. They have to be able to sit in their location and fulfill the obligation. So we deploy e-registration, e-filing, e-remittance, and e-receipt. so that every transaction they do, they can conclude all these transactions, the obligation, everything can be concluded while they are seated in their jurisdiction without coming to Nigeria. And after all those processes have been put in place, then we started appointing the agents. We had two sections of the law to appoint agents. We had the power under Section 10, which was used to for the digital companies. So every company that is digital company. So our simplified regime guidelines focus on digital transaction. And I think we understand the difference between digital transaction and e-commerce. For digital transaction, everything has to be automated with minimal human intervention. So all those processes that needed minimal human intervention was implemented through our simplified regime. However, we also have power under Section 14 to appoint anybody. So for some specific entities that are in e-commerce but are not under simplified regime, we identify some companies which we also appointed in line with the power under the law. Outcome, because of time, outcome, it has been a good story. Because if you, in 2019, when we conceived the law, when the law was made, we were collecting nothing from B2C. And we moved from nothing in 2019, 2020, by 2020 it was less than $0.5 million. By 2021, we moved up to $8 million. But by 2024, 9 months already in 2024, we have done $26 million in 9 months. So that has been the trajectory, the fact that we are able to move from one step to the other. And the expectation, based on the expectation from the field, is that we are expected to do between $35 and $40 million this year. So that is the prospect we have. How far it has been good? When we introduced our simplified regime, the expectation was that after 2 years, we will do on goods, which is this year. But due to some challenges, we had to postpone for goods. And we are still looking at it. The possibility is that sooner or later, we will find something to do as regards goods. Thank you.
Thank you very much, Emeka, David, and Kehinde, for these insightful contributions and for going over time. So I won't have enough time to ask follow-up questions, so I will open the floor and see if we have any contributions or questions from the audience first. No? Yeah, please.
So excuse me if I might forget the name, but it's directed to just the last speaker. In terms of onboarding taxpayers on the cross-border, what challenges have you faced? I'm particularly interested, taking into account that it's quite a long process, and how have you gotten around the resistance from these multinationals coming to register as your cross-border suppliers?
Yeah, thank you for the question. And that was why I emphasized earlier the fact that more consultation is needed before commencement, because this is more of a voluntary process. Yes, we get to, the expectation is that we get to a level that we do some level of enforced compliance. But at the earlier stages, it's more of voluntary process. And that is why in starting, we had to identify business communities to have discussions with them. And that was why ATAF was very useful for us. Through ATAF, we got a contact with a business at OECD, who is a body of those multinationals you are referring to. And we had close to 10 engagements with them. So it's not just what you go once and you think is done. Because in the process, they will look at the guidelines, they will make suggestions. Because we have put this here, we may not be able to do it this way. And so the one you are able to make corrections, you are able to adjust, you adjust. But the one you think is the right thing, you let them know. And if they have challenge, you also let them know how to overcome their challenge. For instance, Emeka mentioned earlier that when we're talking of deemed supplier, one of the challenge was that some of the suppliers believe they can't comply because they don't collect the money. So they put forward those arguments at the discussions. And that was what informed us to provide a rule to say, as long as you are able to collect your commission, because even if you are not collecting the money, you have a process of getting back your own commission. And in that process of getting back your commission, then use that process to also get the VAT element to remit. So we go through all those consultations. Then another thing to enable them to comply is this process should be seamless. That's why it's simplified. It must be seamless. They should be able to register online. So we made that provision for them to register online with minimal requirements, minimal fee. They register online, they make the payment directly from their location, and they file returns directly through our platform. So that is compliance for them. Now, no matter how smooth your compliance process is, there are some that we actually see not comply, and we have them. What we have explored, which we have not been able to conclude on, was the possibility of liaising with other government agencies, because I think I failed to mention that it's also important when you are introducing the rule to also consult with other government agencies. So the consultation we are having is the possibility of having those businesses. Is there a process for them to be locked so that they are not able to make sales in the jurisdiction? And if they make sales in the jurisdiction and payment is being made to them, the possibility of the system automatically being able to collect the VAT, even if they don't collect it, is collected from their money. So we are not there yet, but that is a possibility we are looking into.
Thank you very much, Kehinde. Any other question? There is one question. Yeah,
Yes.
please go ahead.
How can we address the issue of double taxation of goods where the exporting country adopt the principle of origin and the importing country the destination principle? How can we address issues of double taxation?
Thank you. It's interesting who the question is coming from, Raja. So maybe to first of all say where does destination principle come from? Is from the WTO, and that's the concept that VAT is embedded in. Now we still have some countries, but I think it's being phased out that still do again origin principle in certain regions of the world. But I think there are only a few countries. But in that context, it's one of those where probably it's you as a jurisdiction having to intentionally make provisions to accommodate that. So similar, I'll go to income tax where you have reliefs to see how you manage that. Because end of the day, probably the person that would bear that, I know legally we say that the burden of the incidence, well, the economic burden of VAT is supposedly on the consumer in terms of that, but businesses sometimes do absorb that, depending on, again, the type of goods. Now we have to go to the economics of it. Is it elastic? Is it inelastic? How much of it are they able to absorb, and how much are they able to pass on to the consumer? So again, I would say this is a bit of a jurisdictional position, and looking at where this happens, do you give relief? How does that impact, again, the prices when it gets to the consumer? How does it affect the business is important. But ideally, VAT is based on destination principle. So if I'm to be a purist, I would say origin principle is not VAT, basically. Because it's almost like an interaction with where you have sales tax versus where you have a VAT in that concept. But what I can think of is more of maybe a bit of a relief in that context, policy adjustments, because end of the day, VAT is still domestic. There is no international agreement, or if I say agreement, enforceable agreement. That is a multilateral instrument that must say this is how you do it, or this is what should happen. I think that should be the simple answer towards that.
I think that everybody wants to go to lunch. So I want to take the opportunity to say some recommendations, no? which is something we planned since the beginning with the colleagues, and congratulations for Emeka and for you, Victor, and for you, Agua, for moderating, and it was an honor to stay with you in the stage. I think it's very important to continue with the cooperation. I agree with Mr. Prost from the OECD that it is very important to continue having this kind of conversations and events. No? Also, I think that we should do it more frequently, maybe using different tools, like, for example, right now, the webinars, the meetings, the online meetings. In CIAT, we have a very interesting tool. For example, we call it like help desk, where we have bilateral meetings between the tax administration members, where we exchange experiences and we try to make a short technical assistance. It's a technical assistance of 2 hours, 3 hours, just to exchange what is happening between our jurisdictions and what it is useful depending of the case. No? The tools that Emeka and I showed during our presentations with the collaboration of the OECD are very useful, even if it is for Africa or for the Latin America and the Caribbean. It is useful to read it, to study it, because we have very useful information in these studies. And also this deck tool that we implemented in Nigeria. We already have this plan to do it in Australia, in the Pacific Islands. Also, we have it in Guatemala and in Panama. What is the main constraint with this tool is the legal framework. No? The legal framework is something that we need to pay attention. I think that it is useful for the tax administrations to start rethinking the obligations, no? Because we are now facing some challenges, but in the future we will have new economic activities, and I think it's more simpler than we think. No? It is necessary to make it as an obligation in the taxpayer registry and obligate to the company or a person to pay for it. No? And it is the simplest way that we work it since the beginning as tax administration. So I think that it's useful to start simplifying the way we think this thing, no, we are doing it. And also, I think it's very useful to continue the cooperation between the regional tax organizations with ATAF, with CATA. I just want to mention that we work together. We are doing the same job. We are not competing, we are doing the same because we want to do the same for all countries. No? We want progress. No? So these regional tax organization participate in a network, the network of tax organizations. So we will have world meeting in Panama City, in Panama Republic, the next February 18 until the 20, with the sponsorship of the German Corporation. So we will have this on-site meeting to discuss about crypto assets, no? Which is another important topic that we have to cover. So we invite for all the CATA members, Esther, give me the floor and the words to invite all of you, because CIAD is the host, and we hope we can have some of you in this new event that we will have in February of the next year, okay? So thank you very much, and I pass you the word for you.
Yeah, so I think it's time to end the session. Thank you very much for your contributions, and bon appétit.
Yes. So, ladies and gentlemen, it was indeed an insightful panel discussions where our panelists have elaborated about the innovative approaches different countries are adopting to tax non-compliance in respect to value-added. Our panelists have elaborated extensively on the B2B and B2C approach, as well as the inclusive regimes, amongst others. They have also touched upon key implementation issues, the requirement of a proper legislative framework, the need for communicating, engaging, and getting the buy-in of all relevant stakeholders, as well as they have touched upon the origin and destination principle. Last but not least, we also have some good references, such as the VAT Digital Toolkit, which we know now is a document which we need to address to.
Thank you, Ludasan. We shall now proceed with the presentation of tokens of appreciation by CATA. To do the honors, ladies and gentlemen, I have the absolute pleasure of welcoming on stage our new Vice Chair, Ms. Debbie Locke from the HMRC. Join me in welcoming her, please. I would like to start with our moderator, Ms. Awa Diouf. Followed by our panelist, Mr. David Boja. Next up, we have Mr. Kehinde Victor Kasehomo. And last but not the least, Mr. Emeka Nwankwo. Thank you to all our speakers. I would request all of you to please assemble for a photo. Thank you. Thank you once again to everyone. Our speakers, our moderator. Ladies and gentlemen, it's now time for a much needed break. Lunch will now be served. I would request all of you to have a great chance of recharging yourself before we dive into our afternoon session. Enjoy your meal and please be here by 2. Please come to the main conference hall before we can separate panel working group session that will follow in the afternoon session. Thank you very much. Bon appétit.